review today's trade alert, do a Q&A for customers first, and then we can jump into general questions for anybody's on a trial.
And we are live.
Okay, welcome everybody. Today is April 16th. Stock market is hanging on for dear life as unemployment wiped off every job created since the great financial crisis in a month. At the same time, the free money we're handing out to small businesses to try to get them not to lay off staff in hopes that they can reopen their business is out of cash, and they're having a hard time in the government getting more money funded. I would bet that they do, however, but this is really just the start of a big change happening in the economy. And we're going to go through everything you need to know to be positioned to profit in 2020. Okay, so here's your CNN screenshot today with the 22 million Americans filed for unemployment in the past month. I've got a good Jeffrey Gundlach quote, which he posted yesterday. What people in financial media don't seem to understand is that we're never going back to the January 2020, you blow dry my hair, I'll blow dry your hair economy. Saving money and having a net economically productive skill will be the new cool. Not the new cool yet. Right now, the Fed just wants to keep the entire thing from shattering, so they've bailed out everyone, regardless if they have a business model that works or not. And we've got the administration hyping up the release of a game plan to reopen the economy. So let's talk about that, what that may do for the economy, and if we want to change our positioning. So really quickly, I'll just jump to the trade alert and then do the explanation in great detail. So we have a few small changes today, nothing big. I sold my April 17th 159 TLT put. And I'm going to get the chat box up in case I see any questions as we're going here. So if you do have questions as I'm going through, post it in the live chat box. So we're rolling over our put. That's our downside protection. We want our puts to go to a value of 0. That means the asset we own has appreciated and gone up in value. So that's going to be a repetitive trade. And currently we're doing a cheap put option. So I've sold my 159 TLT put, and I've purchased per 100 shares of the TLT, the April 24th 162 TLT put. So again, what we want to have is a put option protecting our TLT position at all times. In case something very nasty happens, we don't want to be at complete risk. So that out of the money put is cheap insurance. And again, we want it to expire with very little value, because that means your bigger position in the TLT will have generated profits. And I'm glad that this is much easier to read and review now, Kathy. Good point. Barry says Peter Schiff and Harry Dent say, he says Peter Schiff says we have inflation coming, which is bullish for gold. And of course, he's been bullish for gold his whole life. I think since he was about in a diaper, he was bullish on gold, regardless of what the economy is actually doing. And Harry Dent says we are in for a deflationary depression. Okay, good points. I think we're going to have a deflationary period and then an inflationary period, which ends with the Fed hiking interest rates several years down the road. So the play I really see is a stock crash, which will probably pull gold down with it and give bonds their big profit boost. And then that's when we're going to want to start building a bigger gold position. I'll go over that in great detail today. But sure, we're seeing a little bit of inflation here and there, but mainly what we have is a deflationary force, because everyone's losing their job. Many businesses are not going to work And so there's going to be a huge restructuring of wealth, what makes money, what loses money. And so right now the Fed is just supporting everything. So you have to make, Dan says Harry Dent has been wrong forever. So we're going to have to make heads or tails out of which businesses make sense and will thrive and which businesses don't make sense and will fail. And so we'll take a look at everything. Today, you have a small job, sell that put, buy the new put, and then let go of your 163 TLT call. So next week, we're actually looking at adding some new put options as well as some new TLT call options. And I do want to see that the Fed slows down the growth of its balance sheet, which has been really our enemy in terms of shorting the stock market. So we'll get an update today. And then I'd like to see one more update next Thursday after the close. So my timing, as long as my expectation is correct, then what I'm anticipating is we'll see the growth of the balance sheet slow down this Thursday as well as next Thursday. And then we'll fill up the gas tank in terms of put options on the SPY. Not this Friday, but next Friday is my anticipation. I'm also closely watching what on earth Trump is going to do with reopening the economy, which could be a disaster, but my instincts tell me it's going to be a phase 1, phase 2, phase 20 slow rollout that keeps the bulk of the population in lockdown, as we just don't have what it takes right now to really reopen the economy. We'll talk about what we do need to do to get there. Barry says, should I convert my in the money call on the TLT and buy 100 shares at 163? Well, let me just explain how our positioning is set, and I would recommend to just copy what the model portfolio is doing, Barry, and that'll always be my advice. So to review, if you're following the basic program, which is Monday, Wednesday, Friday, you should have this set of put options per $75,000 following our total system. Okay, so we've reviewed that a million times. I do anticipate adding to these 4 and potentially a May put on top as early as next Friday. So I do want to wait until next Friday and confirm the Fed is going to nudge the market towards buying bonds, which they do by slowing down QE. QE is great for assets. And so that's what's been really keeping the stock market alive. But if you print too much money, people lose faith in the dollar and you end up with the same end result, which is people start selling US assets. So they have to be careful with how much money printing they do. And again, we'll take a quick look at that. That's the only reason why we've begun a early gold position, despite seeing deflationary nightmare right in front of our face, is that they are devaluing currencies currently. But they're doing it for good cause because of a massive wave of deflationary pressures. So that's really their go-to playbook. As you guys know, we want to buy the companies that will thrive, not struggle, after there's been a huge repricing in the value of assets. So this is the set of assets I think will be a bargain and thrive after a reset has occurred. So it's not a recommendation to buy that now. FANG stocks are back to new highs today, which is silly. Ad revenue for most of the FANG companies will likely drop by, I'm guessing, at least 50%, maybe more. So those business models really are overvalued currently. Okay, so per $75,000, we have 200 shares of the TLT, 400 shares of GDX, and they're protected with a married put. So again, we would love for our put options to lose value and for the underlying asset to go up. So let's take a look. We have this set of call options and put options against the TLT. Remember, your put is called the married put. We do want that to lose value and for the TLT to go up. That's the best outcome for us with that. Then we have these 3 leveraged bets that the TLT will go higher. So we're getting basically a cheap loan to invest in these call options. If it goes up, we make a very handsome return on these positions. So we're currently up on all of these positions, and I anticipate, again, adding to that likely next Thursday, worst case next Friday. And again, I do want to see the Fed is tapering down its quantitative easing, which is the perfect setup for us here. Now, GDX, I do not recommend picking up the 23 put, but I do recommend buying the 821 $28 GDX put. My anticipation is that gold is married to the stock market, whether it likes it or not, and that when we do get the next big leg down in the stock market, we'll see everything correlated to stocks go down as well. So probably spot gold will go down the least, but I think gold miners could potentially crash quite hard. So the plan is, again, to not sell your shares, but to sell the put option. And the game plan here is we want to get that 1 year buy and hold period over with, so that in a year from buying your GDX position, you'll be able to start selling some of that for a profit at the lower tax rate and start getting in on spot silver. And we've looked at that sort of 1-2 punch. You get the stock crash, gold miners rebound before stocks, usually get a 1 or 2 rebound. And then when gold's super, super hot, you can see silver really take off. So that is the same pattern I expect this time around. And for those of you who like the digital coin space, same thing with BTC going up first, and then I think you'll see those smaller coins chase it afterwards. So we'll cover that in the boot camp today. What price point I'd recommend getting in on BTC. Short term, BTC is also acting as another good leading indicator for us. We're seeing that the same fellows who are moving the big markets have a chunk of money systematically selling precious metals as well as digital money at the same time. And because those assets are so small, they're going up before stocks do, and they're going down before stocks do. Okay, the next position we have is the 42 EEM put, which is in the money. So I'm not recommending that right now, but we did replace it with your FXI put. So this is targeting China directly. And again, I do believe we will start having geopolitical tensions with China that will result in limiting capital flows to products like FXI. Now, BlackRock's not going to like that. We know the Fed has BlackRock managing all the funny money. So there are certainly some tensions within our own powerful structures in the United States that are definitely not on the same page. So it's going to be quite interesting to watch play out. This is currently a recommended position, which is, again, 10, 11, 20, 31 FXI puts per 75,000 following the program. How's our returns looking? Well, we blew it with selling those TLT calls early on in March. Some of you guys did get out. I said, if you have bills to pay, sell those puppies. Some of you guys held like I did. We ended up okay. So we're still at a 2% return for 2020. The only thing that went against us was not predicting the move in March for the stocks to continue going down, but the TLTs sold off at the same times as stocks, which we did not anticipate. We went short in the stock market with just under 10% of the total account with 2 years of duration. So our current drawdown is sitting on those puts as the Fed did come in and aggressively bid up the stock market. So my anticipation is we will increase that position again next Friday. I want to see the Fed's balance sheet growth slow down this Thursday and next Thursday, which they have been signaling, and also reducing their daily purchases of treasuries. So it looks like they've stabilized the market for now. And I think what happens next is a huge leg down. Keep in mind, the stock market in 2008 only dropped most of its losses in 3 trading days. So it really can happen quickly. You don't want to sit around and wait for the crash to occur. It's much smarter to just build your position, sit back, and give yourself a lot of time premium. So again, our puts cover us into literally 2022. So we can sit back, be patient, and those are my highest return trades for the basic program that I think you'll see probably in the next 100 years because the market's so overvalued and the amount of unemployment and market destruction heading our way is equivalent to the Great Depression. Okay, so that's a review of our trades. I do want to look at some data here, which I think is quite eye-opening. So let's just look at the big picture here. So right here, I have a sheet we looked at yesterday. And I do have some evidence to report that can further back this. So first of all, the most accurate data that's the least likely to be hidden is counting the deaths. Now, there is reports of all sorts of people dying, not getting tested, getting rushed to be cremated. But I do think anybody who had some wealth will be tested by their family if they have family left behind. So I do think this is our most accurate statistic, at least for the US, to focus on. So currently, the death count, oh, this is actually worldwide, my apologies. So I'm looking at a handful of countries individually to get an idea of whether this is going to die down anytime soon or if it's just getting started. So we can see, despite the quasi lockdowns around the world, this is logarithmic, so exponential growth, 10, 100, 1,000, 10,000. In other words, for this to go up, it really requires exponential logarithmic growth. If it just has the same daily deaths, this will flatline, which is what everybody's hoping will happen. So currently we're sitting at 136,000 deaths worldwide. Okay, what about the US? In the US, we hit a total of 28,000 deaths today. And if we go to our log scale of the death count, you can see once again, it is still growing exponentially. So there's really no reason to think that the peak is behind us, as administration is really flaunting today, as well as yesterday's press conference. Okay, what about Singapore? Much smaller, super rich, fanciest healthcare system, isolated on a little island, super hot temperatures. Well, they had the biggest jump in cases yet just yesterday. And again, this is log scale. This is with total cases, so it's not their death count. If we do go to the death count, they have very few deaths. So good news in that front for Singapore, but in terms of being able to stop the spread, really no evidence to suggest that a advanced economy with extremely high-tech facilities that's isolated on an island can successfully stop the spread. So that is bad news for anyone hoping that summer months could potentially slow this down. Okay, the next thing I'd like to bring to your attention is this data. So I've been curious, how long has this been spreading and how rampant is it already? What if we've already had it? I know all of us probably in the early months have sat there and said, gosh, I had a headache or I had a sore throat, a cough. Did I already have it? That's a question I'm sure it's on the top of many of our minds. And there's been some data, particularly in a German town where they tested a random batch of 1,000 people, and 15% had antibodies versus 1% were infected. So it led me to think, well, if we can state that there's about 1% in the population who currently has it, what does that tell us about how many people have already had it in the past and how long has this been spreading? So it does look like this began perhaps in the summer of 2019 in China and had made its way to perhaps Washington State as early as November, as well as California. So this could have been around much longer than we anticipated. So here's some data that does dig into this. The antibody tests are supposed to be getting out, I believe, next Tuesday. And so that's a really important test that potentially could help us get our economy rolling at some capacity sooner than perhaps perceived earlier. Now, there's some caveats to that that we can look at, but let's look. So here's a Yahoo Finance report, and I'll zoom in on it. Of 215 women who delivered babies at the New York Presbyterian Hospital from March 22nd through April 4th, 214 were tested. And here's what's interesting. 15% tested positive. And I don't believe they did the antibody test in that case. But that's remarkable that 15% of the women giving birth did have it in New York City. So that's interesting. The headline in this report is that 1 in 7 New Yorkers may have already had the, can't say it. Okay, so that's interesting. We have the test in Germany that really had the opposite result. We have another test in Iceland. A randomized testing of the population found 0.6% of those tested in late March and early April have the disease. In San Miguel County, the mountains of Colorado, a ski town in Telluride, they did widespread testing of antibodies, and as of Tuesday, 0.6% had the antibodies. So that's not good for hoping that most of the United States has already had it. So this is sort of data I'm highly interested in going forward. There's not a lot of information. So let's look at the data and how that could impact what we're projecting to get a feel for whether, have we really gotten close to the worst? Have we gotten near herd immunity? That's really what the human population needs to do outside of a vaccine, right? Okay, so if we have 7 billion people on the planet, I've wrote it as 7,000 million. How many are at risk of infection? Well, let's say half. Okay, but of the half that are at risk of catching this, let's assume only 1/3 will actually have symptoms. Now, I think it's more like half have symptoms based on some data from, for example, the Theodore Roosevelt. They've been doing a lot of testing, and these are very fit people, obviously, in the military. Looks like more like 1 out of 2 people who have it will actually show symptoms, not 1/3, but we're lowballing everything. It also looks like more like 80% of the population could actually catch it, not 50%. So again, we're just underestimating to show just how little of this transmission has been completed. Okay, so 1/3 shows symptoms. That gives us 1.1 billion people who potentially will catch it and show symptoms. Next, of those who do show symptoms, how many will lose oxygen? Okay, and we are seeing it sometimes happens from the lungs getting infected, but it does appear there's another method that gets you low oxygen that could be directly going after the blood cells instead of the cells in your lungs, which is bad news. But let's just say instead of the current statistic, which is 20% of those who do have it go to get tested because they have symptoms, we're seeing actually 2 out of 10 end up in the hospital. Let's cut that in half. So now we're down to 115 million human beings on the planet that by the time this works its full damage will need hospitalization. Okay, of those who need hospitalization, we're seeing about 1 out of 4 survive. Okay, but let's flip that. Instead of saying 1 out of 4 survives and 3 out of 4 pass away, let's do the opposite. We're going to say 1 out of 4 will pass away, 3 out of 4 are going to survive. And that's because of all the miracle therapies that are not proven to work are going to suddenly start working, even though they don't yet. So we're making a lot of assumptions, trying to cut this down to look as hopeful as I possibly can make it. Okay, so with all these lowball estimates, assuming we don't keep the economy locked down for 2 years waiting for a vaccine, and that we're not able to slow the spread, which again, we'll look at how we could potentially open the economy and try to slow this down. Okay. 28 million people pass away. So far we have 136,000. And that means we've completed, if you thought of this as a download, we've downloaded 0.5%. Or if you're charging your dead phone, you have 0.5% actually charged on your phone. So however you want to slice this, we're nowhere near the end of this problem. In fact, it's just insane to consider that we're anywhere near the point of being able to open the economy and let things go back to normal. In fact, I really don't think things will be back to normal until we have a vaccine. And a lot of questions arise about whether a vaccine will work and what are the long-term implications of catching this? Is it really like the flu, you get it once and then you're done? Or is this more like HIV and it gives you problems for the rest of your life? Okay, so now I said, well, what if I'm off by a factor of 10? So we've already cut every number in half. Let's say we just didn't track this for most of 2019 or early 2020. Let's say we're 10 times wrong. Well, even if I was 10 times wrong, which I don't think I am based on the data from Iceland, the data from Colorado, even the data from New York wouldn't suggest we're wrong, which is probably the highest concentration in the States. If we said we're 10 times off, we're still only 4.7% done, nowhere near herd immunity, which is getting at least 60% of the population to develop antibodies. Now, I could go on for a lot longer about some other risks, like, for example, they're testing children for antibodies who are beating it, and they don't have antibodies. So it's really curious how they're able to beat it, and brings to question, would a vaccine work for a child? Well, maybe it wouldn't. So the children are going to keep spreading this. Scotty says you just did the Fermi paradox of the disease and the Drake equation. You have to tell us what that means in a little bit, Scotty, after I get through my content. I'd love to hear that. Okay, so let's talk about what we're going to do to slow the transmission if we do go open the economy. Because realistically, it's just this is a problem that you can't solve. The solution is going to be painful no matter how you dice it. So, as I've been saying, a global 60-day shutdown, reemerge with masks and massive testing and identification of who's got it, who doesn't, is really the solution. Okay, so this involves taking away constitutional rights for 2 to 2.5 months. We've already got the hardcore conservatives running around with AK-47s surrounding government buildings, gridlocking highways. So a lot of people do not like the actions we've taken. But yeah, let's talk about it. So if we all emerge with a mask, we start getting massive testing everywhere. You have some sort of identification that lets people know whether you've had it or not, whether you have antibodies or not. And then we all have a mask. So right now they're pitching to just go find a piece of cloth, throw it over your face. And I would say that's sort of like thinking that your house will block a radio wave. The cloth is going to turn into a magnet for collecting the disease. And it's going to do absolutely nothing to actually block this virus. So what I have here is just to give you a feel for the size. So I was talking to my aunt. She's made her own homemade mask with a cotton cloth, and it's gonna do absolutely nothing. It's gonna give her a false sense of security, and it's gonna sit there and collect germs, it's not going to do anything to block them. So it's really important you get the right type of mask. And I do have a cool article where a group of people have gone out, tested all sorts of materials you can find currently at your Home Depot to build your own mask that does work. And they've tested a bunch of designs to see which actually fits tight, because your handkerchief strategy is just not going to cut it. So right here we can see, now if you're like Dean literally went out and bought a full bodysuit, a gas mask. He's told me yesterday, why don't we just get everybody a full bodysuit? We could look like we're on Mars. That would work. So that's not a bad idea, but it is, what was it, Dean? Like $1,600 a suit?
Yeah, 1,600.
Yeah. So we can't even get everybody a damn N95, not even all the doctors and nurses, much less the population. Okay, so here's your blood cell. It's huge right here. Here's a E. coli bacteria. This is the one that Wim Hof was able to kill in a hospital setting faster than people with antibodies could beat, than antibiotics could beat. So if you guys like Wim Hof, I love Wim Hof, probably the best thing you could do for your health. But look how big that puppy is. And again, I don't know if his secrets will really work for viruses, but it is documented he did kill E. coli injected into his body with no antibiotics faster than a group of people who had antibiotics. Quite amazing. He sits there and does deep breathing, which has got to be good for your lungs. So where is the you know what in the scheme of this? It is 12. So we don't even have something that's small enough to compare here. It's half the size of this bacteriophage MS2 right here. It's a third of the size of your typical rhinovirus. That's your common cold. And you can just go up the, here's Ebola. So yeah, it's just a fraction of the size of anything we know about, which is why our science doesn't work. In fact, scientists can't even tell you how a photon of light travels from point A to point B. It doesn't go in a straight line, and they can't predict where it will land. So our ability to work in this spectrum of small is in the dark ages. And one reason we have such hard time creating vaccines for these. So if we go roll out the economy and tell everybody to wear a mask, they're just going to be magnets for disease. If you are infected, it's going to go right through that into the air. And if you're not infected and you happen to breathe some in, it's going to come right in at you. So that's not a good plan. Okay, so that's really the big picture of what's going to keep our economy at a limited. Okay, MH says you might be overlooking divine intervention. Well, that is what we need, M Hawk. So I'm with you on that one. Would love for that to come on through. Claudia says, I thought this was a portfolio builder webinar. Yes, it is, Claudia. And so sometimes a little science is critical to predicting the future of your economy. In this case, that is exactly what you need. So we have a huge problem. We have no solution. We could turn the economy back on, and this will start to grow at rapid pace. So my expectation is the economy will remain in a lockdown or severely restricted, which means that companies are going to be hurting. And again, gets back to our exact same prediction that you want to be long bonds and short stocks. So let's circle back to the trade alert one more time. There's really just no hope that we're going to have an economy that runs anything like we had in 2019. So the relative valuation of companies is greatly overvalued. We'll be lucky to get our economy working at 3/4 the capacity it was last year, more likely at half or 1/4 the capacity. And so once you start to understand how momentous the stock market is and really relies on constant steady flow of buying to remain elevated, the second that funny money they printed runs out, the momentum will flip. And I do foresee a massive stock market crash, something like we had 1929. So deflationary, not inflationary, no rate hikes causing this crash. So really the play is to own bonds. And again, we're looking for two things in the stock market: growth of profits. Acceleration of growth of profits is really what you want. And in the bond market, we want to see a growth. Mark says, please slow down when you're moving the frames. Okay. Very good. Thank you. Thank you, Mark. Which screen did you need to see that I could go back to?
None, it's just
Just
when
in
you-
general?
Speakers. Someone does.
Okay, got it, Mark. I'll make sure to move the frame much slower.
Okay.
Okay, thanks. So yeah, our expectation is profits and revenues are going to be crashing. There's a report out from Expedia talking about how the FANG stocks are in trouble. The CEO says they typically spend $5 billion a year in ads. Now, again, this is travel related, so they're hit hardest. He says he'll be surprised if they spend $1 billion. But a lot of the advertising and things like Facebook and Google are not products that work well from home. Much of those are local ads. So all of them are going to see huge drops in revenue and profits. So this economy won't be the same, and we're nowhere near the end of the trouble. So to review, how are we positioned? We have a set of 5 put options per $75,000. These are going to act as the foundation to the house we're building. The analogy is the house is your portfolio, and we're building it in stages. So stage 1 is lay the cement. Those are your puts. Right now, your walls are built out of cash, but after the market has been repriced to reality, which I think will be sometime around August or September, we expect to convert your cash into the companies that should thrive. So who's going to thrive? Well, I would say that healthcare, biotech, medical devices, and e-commerce are really the direct beneficiaries of the debt currently being issued because of this crisis. In fact, it's going to be handed right off from the government to your healthcare, biotech, medical device companies. Now, e-commerce is just thriving because of the new change in consumer behavior. So right now, because of a $1.5 trillion injection of cash into the financial system, it's hard to tell what's a good business and what's a bad business. But as time progresses, that will become more clear. And I do believe with our understanding of the problems in the economy, we can easily predict those. In terms of, again, increasing our risk in the put options, we're going to wait till next Friday to see that the Fed's balance sheet growth has slowed down 2 weeks. So we get a report today, which I'll review with everyone tomorrow. We'll get another report next Thursday. And if we see that they are tapering down quantitative easing, I will be increasing our risk in the put option position. At the same time, we'll be increasing our risk in the TLT call option position. Now, a final review of the rest of the house in our analogy. The TLT is the 30-year treasury. Okay, Bud says, this is first day, my April 17 TLT is up. How do I end it? Sell to close. So you open it with buy to open, you close it with sell to close, and it's at the very top of the trade alert too, Bud. So your roof to your house is the bond market, the 30-year treasury. And this is really the top shelf. This is the patron of the bond market. It's really the best possible asset you could put your hands on. And that's why we have it as our roof. We call it the electricity or the plumbing, our exposure to commodities. Right now, I like gold miners. But again, I expect they have a high risk of pulling back alongside stocks. So we have put options protecting these positions. If you're new, I only recommend this put. But if you're old, I'm not telling you to sell that 23. I think we can flip both of these puts in a couple months and then remain long GDX. And again, I want to get to the 1 year mark as soon as possible so that I can start taking profits off of GDX at the low tax bracket and start a position into spot silver. Now, on one hand, gold should go up because we're printing money and devaluing each dollar. But on the other hand, we have a massive deflationary force, which is predominantly seen in the unemployment numbers. So that's why I wouldn't recommend getting too over leveraged in the gold market at this point in time. But we do have a position that's protected with our put. So we have very little to lose if GDX goes down. And if GDX just breaks apart from the stock market, loses that correlation, we're still perfectly fine. We just have to pay off the cost of our put, and everything after that is a pure profit. So the other position, again, is expecting that US will put the blame to all this on China, rightfully so, as far as I can gauge from the information I have, which is at least 1,000 hours into this. And so we do like the FXI puts right at the election expiration date. Okay, Logan has a question. Jason, are you suggesting that the SPY will not fall until QE ends? Then what happens if the Fed does it as it did in 2009 and keeps QE going for 5 years? Then you crash the dollar and you have everyone sell stocks regardless. So I do expect, and they've been telling us, they've been week by week tapering down quantitative easing. So I'll go over what their strategy is. If you got to think about what's the government and the bank strategy to deal with the crisis that we currently have. Okay, so let's take a look at that. That's a good transition. Let me look at the topical news really quick, and then I'll jump into what's the problem and what's the solution and why you want to just follow the big money, which again is not buying stocks. Big money is buying bonds, including the Fed. So with that said, let's take a look at the news, and then I'll rotate into the problem solution and how you can just simply follow the money. Okay, so the unemployment would be worse, but the government gave small businesses $350 billion. And that condition was that they had to keep their staff employed. So kept unemployment down. And in the end, really didn't cost the government all that much money versus everybody going unemployed. And so their pitch to us, the public that ends up having to pay these debts in the long run, is that these businesses will be able to reopen as long as we keep the employees with a paycheck. So the problem is many of these businesses just can't reopen. So if you think that you're going to be going to a movie theater or a concert venue in 2020 or 2021 for that matter, probably not. Restaurants. You know, if we knew that one person could sneeze and contaminate an entire restaurant, that's going to be troublesome as well. So again, this is really a short-term fix to keep things from unraveling too quickly. But at the end of the day, some businesses will survive and some will fail. It's interesting to see Chick-fil-A adapting so quickly. The entire staff has masks. They have special new credit card readers that allow you not to touch anything that they touch. The whole staff inside has masks, gloves. And so, again, we're seeing some companies really pivot and react quickly. We go over to Wendy's and they have none of these precautions. So patio dining might be the big thing but going into a small crowded room and then eating food is going to be very, very risky. So clearly, this is not going to work forever. And now they've already spent it all in less than a few weeks. So wait till this funding does not continue indefinitely, and more businesses do realize that their business model won't work, at least until a vaccine comes out. Return of popular quarantine stocks since March 16th. Amazon's up 43%, Netflix 50%, Peloton 68%, Zoom 41%. Well, what's going to happen to Amazon? So Amazon had everybody rush out fearfully to go blow every penny they have to stock up on things. But now their income's dropped. The business they're working for is on life support. Are they going to keep up these purchases? Probably not. So really, the entire market has to be repriced. Netflix. When will they produce a new show? Zoom certainly has a good business model, although they're getting all these rumors about being hacked in relations to servers in China. Okay, the US government is crafting a plan to pay shale drillers to keep oil in the ground to support prices and jobs. A lot of long-held concepts are getting turned on their heads these days. So again, the entire economy is turning into one which pays you to do nothing and blows out debt. So profit and earnings corporations are surely to drop like a rock, while the cost to the taxpayer, or the growth of debt, is surely to explode. So that's really the key thing that we need to focus on with positioning, and to determine what is going to make money in 2020 and what will lose. It's also important to predict what will the government do geopolitically. And my expectation is to put a lot of sanctions on China, either this year or next year. And so we can see the cat fights so far, slowly but surely, turning more and more aggressive. This is a communist leader, Hu Jintao. You can't just believe your own information. Lockdown in Wuhan on January 23rd sent out the biggest alarm. What else do you want China to provide? In Shanghai, close to Wuhan, 7 died from, while in Fairway, New York, more than 10,000 people have died, and you blame China. Okay, so to recall, they locked down travel out of Wuhan. In fact, they went and literally put cement blocks around all the highways. There were riots, people are trying to get out, but they insisted that you continue international travel with China. They also locked down the communist kids' school in Wuhan on January 1st, but went on to have a huge feast, free food for 70,000 people in Wuhan, as they knew this had been spreading rapidly. So quite clearly, they are not in the right. China export restrictions strand US-bound medical goods. So also when China was doing all this, they went and seized as many medical supplies as they possibly could and brought them all to China. So it's no wonder our healthcare system can't get enough. And it's no wonder our administration is telling everybody to go make a ghetto makeshift mask, because they can't get them the ones they need that work. Here's that jump in the Fed's balance sheet. If we do go back to 2009, you can see they did one big shot and then slowly continued. The second they tried to reduce it and raise interest rates, we had the Christmas massacre, and then they went right back to buying treasuries and did this huge leg up right here, which I believe will begin to taper off. Meanwhile, $1,200 will last you 10 weeks. Yeah, right. Okay, Bill Gates finally came out, something about the WHO. So we all know Bill Gates funds 10% of their budget. And it's quite clear WHO has misled the public. So the question is Bill Gates a good guy, a bad guy? He's out there pitching the 10-week lockdown, the forced vaccinations, the bio ID, critiquing the usefulness of therapies. And he came out yesterday or 2 days ago, halting funding for the World Health Organization during a world health crisis is as dangerous as it sounds. Their work is slowing the spread. And if that work is stopped, no other organization can replace them. The world needs WHO now more than ever. Peak Prosperity responded, I strongly disagree. The WHO is a defective organization that failed as an institution. Painful lessons aren't just for kids and the poor, Bill. But if you think the WHO shouldn't suffer any money consequences for being dummies, then you fund them. Now he does. The PPP program is almost out of money. More than 1.4 million loans have been processed, totaling $311 billion. And again, that doesn't have to be repaid as long as it's used to keep those unemployment numbers lower. Wrap your head around this. Jobless claims last 3 weeks, 16.7 million, 5.5 million forecasted today, 22 million total. And the stock market's going up. What a joke. Nancy Pelosi has deleted the video from February 24th, encouraging people to come to Chinatown. Sure sucks having a digital record of everything out there. More than 22 million people have filed for unemployment over the last month. To put that into perspective, California and Texas are the only states with more than 22 million residents. Hu Hijin, Fox News published a ridiculous, now remember, Zero Hedge reported this exact same information in January, and Twitter delisted them from their platform. Okay, Fox News published a ridiculous report claiming the virus originated in a Wuhan lab. President T helped hype this story to divert the public's attention. It's a dirty trick. T will further exploit China topic for his re-election campaign. He sure will, and I can bet he will also connect the dots between Mr. B and China. Now, again, Google censors a lot of keywords, a lot like China does. So we're having to be very careful what we say live. Los Angeles Mayor Garcetti says gatherings like concerts and sporting events not likely to be allowed in the city until 2021. Asia's economy is likely to suffer zero growth this year for the first time in 60 years. I'd say probably severely negative growth. And here's your US fuel demand falls to the lowest ever. And really the best indicator of how healthy your stock market will be in the future is to look at how much money is being pumped and purchased into energy products like oil. And we've seen the biggest crash in oil demand in history. So here's just one chart with gasoline demand. You can see we've never seen a print like this. President suggests the nation has passed the peak on new coronavirus cases. Well, maybe, but not when you reopen the economy. So we'll see what exactly his plan is today, supposedly. I'm going to guess it's a phase 1, phase 2, phase 20 that does keep the bulk of the population locked down until we have, again, testing everywhere, rapid fire testing, both if you have it or if you have had it. It needs to be fast. It needs to be everywhere. You're going to have to be identified to be able to have access to going into public locations. And you're going to have to wear a good mask, not a mask that doesn't do the trick. So I think with all of that, we can have a limited economy operating and keep our medical system from being completely collapsed from just too much. Here's your oil demand. And again, we've just never seen anything like this. Just the entire world essentially shut off. Jim Rickards, great historian, huge gold bug. I believe he sold his bond position. Karen sent me his newsletter, I think, what was it, last week? Now, I do not agree with him. And you'll find there's a huge group of people that no matter what the case is, for their end result is you got to buy a bunch of gold and that's it, because they don't like the way everything works. We'll look at the way things really work in a moment and why I'd suggest you're quite early on gold. Now, also Ray Dalio was on an interview, I believe yesterday, with Bloomberg. Interesting, because Bloomberg does have index funds funneling tons of money to China. They also have a ton of their terminals in China. So they're highly, as well as Ray Dalio's a very early investor to get rights to manage money in China. So he's definitely got a lot of his funds money at risk if he doesn't keep those two parties happy. And essentially he said that stocks are going to be revalued. There'll be winners, there'll be losers. There's going to be major change in social and consumer behavior, and that you're crazy to buy bonds, which is funny. The last thing he said you're crazy to own was cash. Cash is trash. And he was actually kind of pitching gold to a degree. So interesting interview. I'll make sure to include that for Tuesday's boot camp study material. It was a good one. And I do like to listen to Ray Dalio, even though I don't always agree with him. Got to take his bias with a grain of salt, just like anyone else. Evidence that the Wuhan virus leaked from a lab, whether intentionally or accidentally, and has been weaponized by Chairman Xi, keeps accumulating. So it's becoming a breakdown of where the government aid goes to. So a little pie chart, those who don't need it, 99%, those who need it, 1%. So just a joke. Okay, great. Let's look at some more information, but take a quick break for questions, and then we'll review our product options with Dean as well. Any questions out there from anyone in the crowd? And while we do that, we can also have Dean go over our different products and offerings. Now, Ross says, tell that China kid on your site to go to China Tribunal. So yes, China is to blame for many things. Get home to read this to him. All right, I'm not sure which China kid you're referring to, but I'll definitely check out that resource. What questions do we have out there? Anybody want to open their mic up?
Yeah. Hello?
Hey, Jack, how's it going?
Yeah, I have a question that is always in my mind that I need your knowledge. What happens if this inflation is coming, like you said, probably about 50%? Don't the price of the stuff is already been priced in for those inflation because they are, $40 used to be and $40 now, so that should be only value is only 50%.
Inflation only happens when you have a red hot economy with everyone fully employed and too much money sloshing around. So we have one ingredient. We have a lot of money printing. What we don't have is a red hot economy. In fact, we have an ice cold economy. So in one side, you have a increased cost of production. So labor costs are just screaming up. Nobody wants to work. They're scared to death to work. In fact, they don't want to work when they get paid more to sit on their hands. So you have a higher cost of goods, but at the same time, you have a significant drop in income. So you have less money to buy goods and a higher cost. So that's a disaster. It looks just like 1929 leading into the Depression. So I think we're going to have a 1, 2, 3 year depression. Prices crash. Our economy has to figure out where to put resources, what actually is a useful place to spend money and to put labor to work. And that's going to put a lot of businesses out of business, and new companies who do adapt will thrive. And so this will slowly but surely fix itself. And I do think your big push in gold is going to be delayed.
I see. But is it is the like giving an example if the like any stock right now, like if it's $40, do they already price in, the investor already think that this month $40 is supposed to be, used to be $80, now $40 is because that is not this, I mean 50% off on the value. They already price it as the stock, so that's why it doesn't go down more.
Well, the corporations are on their revenue growth and their profit growth. So if we anticipate that revenue and profits are going to probably collapse 25, 50% for good companies like Amazon, then yeah, I would say that just give it a little time. I know you guys are all looking at stocks that have gone up because we injected $1.5 trillion, but promise you it won't last. Tony.
Out for the loans like Tiffany applied for.
Karen.
Hey, I've got a couple of questions on the trade alert and a few things that you said. On the GDX, you working in our, or if we just move that to cash temporarily?
On the verge of the big leg to save the market, to get similar. So it's kind of like a double win. If a push that could last a year or two, but divergence. Now, there's really not been a divergence in history where it breaks path, at least in the. I prefer this setup. Ash, if I'm right, we sell that put, and then we hang on to our shares.
Okay, that's your full thought on that because you had mentioned it to keeping it the year, and then in the same putting on a silver position, verify that. And keep my eyes open inside of an IRA, for instance. And so it does, but inside an IRA, it just simply doesn't. So I just thought, well, let me see about taking advantage of it if possible, depending on what your thought was. Okay, enough of that one. TLT, it's flirting 170 today nicely. And I think it's going to go to 180. Continue on that upward, even if it's slow and grinding. We've got that next one out to May 15th. Now, I actually have a lower strike on it because back when you were putting your, what you were getting for those, as you were putting those on, I was trying to match some of, looking to see what the difference was by the time I had a chance to put that on. I actually got the 155s instead of the 157. So I have a nice little profit on that right now. And I'm looking at that saying, are we going to be seesawing again? And I can go back in and kind of capture some of that now, or, so I'm trying to get an idea of what you think that TLT is going to do. It didn't, it didn't go flying upwards like it did the last time, but it is on the grind. And I'm wondering if you think it's going to continue that path, or if you think we're just going to take a bit of a breather and, for the next week or two or whatever. And then maybe I could, I could throw it back on there again, before we hit that May 15th exit point. Just kind of trying to get your mindset on that.
Sure. So yeah, I'll go back to, this is a great book if you guys haven't read it, A Random Walk Down Wall Street. My belief is that it's far easier to predict long-term outcomes than it is short-term outcomes.
Okay.
So my basic thought process is that the TLT is going to rise over time, and that stocks are going to crash over time.
Okay.
So I don't have that. Now, I do think if the balance sheet is reducing, which I, with high confidence, believe it will, this Thursday and next Thursday, that the TLT will go up.
Okay.
So if there's less quantitative easing, it's essentially signaling that you have to buy and hold your bonds and wait for them to come back with QE, which is what they want. So we'll talk about what's the problem, what's the solution, how do these big banks make money, and how that impacts our decisions. Let's go with Oscar. How's it going, Oscar?
Hey, Jason, how are you?
Doing great. I didn't get a chance to watch that video you sent me this morning yet.
Well, look up the guy. Look up the guy. He's got several videos out there. That one bummed out on me, so I'm not sure if it's a faulty video or you know, it's my player or whatever. But guy makes a lot of sense.
Oh, what was the just the nutshell?
Just it really gets into the biochemistry of the disease.
Oh, cool.
And how to treat it, and you know how he thinks, you know, Gates and the WHO are in cahoots and all sorts of stuff.
Oh boy. Okay.
Really interesting.
Is
On
it
the
George
other hand-
Webb by chance, or
I'm sorry?
is it George Webb by chance?
No, I don't think
Okay.
so.
Okay. Well, that's
And the
another
oth-
guy who's been trying to line up all the characters.
And the other issue Karen brings up, that short term, if she's successful, I want to take her to Vegas.
Sounds good.
You got a little while to wait, kiddo. We're not going anywhere. But thank you for the thought.
Hey, though, I bet you the planes and everything's cleaner than they probably haven't cleaned those planes in a decade till this all came out, huh?
Let me tell you, you know, this is the same old theory. It's kind of like when well, you guys were kids. I don't even know if yeah, I guess you were just little rugrats. When that DC-10 did the little cartwheel over in Iowa, and they grounded everything. You know, I had plans to fly to Hawaii out of Miami, you know, with a stop in LA the following, well, I don't know, it was less than a week after they were up in the air, and everyone was panicked. And I said, why? They've just been inspected. They're safer now than they've ever been. And I was about one of the few on the airplane. I was like, oh, that's great. I had the best service. So
Yeah,
you're exactly right. Everything is very much, yeah, there's not much going on up there. I can get the scoop. My colleagues are mostly home. So, or my former colleagues, they're still working. They're not going anywhere. The ones that are, you know, they take pictures. There's one person in the cabin, you know, they're carrying, you know, people who are the volunteers, the medical volunteers, you know, that's who they're carrying. And that's about it.
Yep. Let's get Kathy Crickman. Go ahead.
Along the same line, I like looking at graphs, and your TLT graph just says, yeah, I'm going to keep going.
She's feeling it. Well, we'll talk about why it has to go up. Otherwise, everything goes down. But I like that chart too. But again, I'll tell you, it's always a random walk. You get some billionaire dumping this or that because he has to fund this or that, or he wants to trick some competing hedge fund or whatever. You know, it's a pretty diverse ecosystem in the markets, and so there's always surprises. But again, you know, we think of the Fed throwing that baseball high up in the air, sure looks strong, but boy, that gravity does bring the baseball back like clockwork, doesn't it? Jack, do you have a new question?
Yeah, I just want to ask you about the position on TLT on a put. I mean, on a call. Is it better? I mean, I'm actually I'm following you, but I buy a few more of those TLT call. Is it better to buy the one that is the closer one to buy, or is it longer one to expired? Which one it is?
Wait till next week. I'm going to give you some more juice. I know Jack likes to make big returns. He killed it on Tesla, and he wants to keep up the success.
Yeah, I kind of
Give me another week. Give me another week, Jack. I'll issue a more aggressive position next Friday. I want to see the Fed's balance sheet taper off today, and I want to see it taper off next Thursday, and then I can give you a much higher confidence that this is the right timing.
Yeah, I know. I sold my Tesla at the wrong timing. I sold it at 500 something. I should kept it.
It's okay. Tesla's a joke.
I
Yeah.
bought a put and I lost $21,000. Shit.
Oh man.
Oh my God. I got being.
So yeah, guys, I'm really careful about risk management. So sometimes we're off on the timing by, in this example, we're off a month on the puts. TLT's been doing fine. But because I wasn't a gambler and put on the right risk exposure, I'm really not hurting. And in the grand scheme of things, I'm still highly confident in my targets and the times and the dates. So it's being a little patient sometimes really pays off. Now we've had the opposite. We've had Mark Stoley, for example. He's gone more aggressive in the past. He's taken profits early and he's killed it. But then he went a little aggressive on these puts and now he's hurting a little bit on those puts. So do realize I carefully calculate what percentage of our portfolio is at risk at all times. So right now, new people coming in have much less risk than we originally did. And I'm aware of that. But because I have to serve the entire audience at a single moment at all times, I'm just waiting. We're letting this run out of steam. We're waiting for the Fed to signal the top, which they do by tapering down the balance sheets growth, which I anticipate will show less growth today and less growth next Thursday. We're also following catalysts like, they're going to do a whole dog and pony show for us that the worst is behind us and that we're going to open back up the economy in phase 1 through 20. So there could be another little push, maybe not, but a little patience and letting some time pass really does a lot of benefit towards risk management. Dan, please.
Hi, Jason. Listen, first of all, thanks. It's been great, especially the TLT. Personally, I've had a little bit better luck just owning the TLT than I have in the options, but they'll come around. And that could be me too, because my timing's not always great. But I'm not a technician, but I fool around. And God, when you look at this chart of this TLT, even going back as far as 10 years, I mean, we're talking about something that kind of wandered around $100 for 4 or 5 years, and kind of got up into the 130s, 140s, stayed there for a while, and now has just literally traded between 140 and 180 here now. How do you? I'm not questioning the thought process. I'm just trying to imagine how you imagine this going to, say, 300.
Sure. Great question. So first of all, it's really important to realize TLT is not Amazon and it's not the SPY. Okay. So it's not a company. It doesn't have employees. It doesn't collect revenues, doesn't have a balance sheet. It's really nothing like that. Okay, so what the hell is the TLT? Because it's completely foreign to most investors. But like Dan said, it's like, holy cow, this product just keeps making money for 40 years straight. Why? So the simple answer is the mechanism that allows the government to increase its debt requires a little trick at the Fed that's very beneficial to big banks. And so I'll take you through that mechanism. But just to really sum it up, if the government wants to grow its debt at a accelerating pace, so it's one thing to just have $1 trillion of debt every year. It's another thing to grow that, especially at an exponential rate. So we're going to go from selling $1 trillion deficit last year. I think it was more like 1.2 trillion. This year, we're going to have to sell probably a $2 or $3 trillion deficit, and probably even more next year. So what's the mechanism where does all this money come from? It's not coming from the US economy, okay? Because that, by definition, the deficit is the money the government wants to spend that it could not collect from tax receipts. In fact, we're having a tax holiday right now, right?
Right.
So how in the hell does it pull this off? How does it grow its debt at an accelerating pace? And so it really takes two factors. You need a crisis, and then you need to drop interest rates, and you need a central bank that will buy the debt. So that's really the three combinations that allow it to aggressively grow the US deficit. So if we do look at a few moments in time where we saw this go up in value, notably 2008 crash, we went from leading into it, we went from 84 to as high as 124. Okay, so that was the mortgage collapse. Call it the Great Financial Crisis. Then they did quantitative easing at the end after they had filled all the holes. So the Ray Dalio interview, I'm going to send you guys on Tuesday. He does a great job really explaining current predicament. And he says, you know, we're basically trying to fill the holes as fast as we can. But usually the game plan is we fill the holes and then we do quantitative easing to vacuum out the debt. And that's what we saw here. So we saw the big run up in the TLT, which represented filling the holes. After the problems had been fixed, we vacuumed all that debt out and all the money went right into the stock market. So you get that crash back here and the stock market went flying up. Now this time around, and again, this little period right here is actually a full year for that move to go up and down. So,
Sure.
okay, so we go to here. We just did both at the same time. We cut rates, we're filling holes, and we're vacuuming out that money. And it didn't even budge the TLT. So that really is that's your giveaway that this stock market rally is complete BS. But let's look at this. So yeah, it looks just outrageous. It's going straight up. Why would anybody buy this thing? It doesn't have employees. It doesn't have products. It doesn't make profits. It doesn't have revenues. What on earth is it? And why does it keep going up over time? So let's look at a few things. So, okay, first of all, in this chart, we're looking at a century of stock returns on the Dow. And you can see in each gray bar, that's a recession, stock crash like clockwork. Every single time we have a recession, there's a stock crash. Okay, so I would argue we're going into recession or depression. The worst one was, again, 1929 deflationary crash right here. Boom. So, okay, that's part one. Part two is to understand what the central bank does to deal with recessions. So this only goes back to the 50s, but you can see, same gray lines, that's where the stock market crashed. What did the Fed do ahead of every single crash? And why did bond market go up every single time this happened? So you can see before the crash, the Fed saw the problem and they cut interest rates into the crash. So the interest rate cuts did not save the market, at least in real time. So why are they cutting rates? Why does that not save the stock market? And why do they do it into a stock crash? And why does the bond market go up every time stocks crash? These are really the questions we need to ask. Okay, so the next thing we want to look at.
I think we had a question from Julio. Let me get him unmiked.
Okay, hold on. I still have to answer this question.
Sure.
Okay, so next thing we got to look at here is quantitative easing. When does this typically happen? So last time we did a big jump similar to this one was after the 2008 crash. And then boom, they added $1 trillion, and then they added another $800 billion, and they added another $1.2 trillion. But again, we're going to look at the timeline of this. Okay, next thing I want to bring to your attention is the product we're actually trading. Okay, so we're loading up the all-time history from the treasury.gov. of bond yield. So it's really important to understand there's two parts to a bond. Part one is the yield you get. And part two is the value of the bond you get after the bond is complete. So it makes sense. The bigger your yield every year, the less money you're going to get at the end of the bond, right? And the less you're getting up front, then obviously the more you'll get at the end with the bond. So with a 30-year treasury, which is what we're playing in the TLT, we're actually less interested in the yield we're collecting, and we're more interested in the value of the bond at the end. So if the yield goes down after we've bought it, that means the value of our bond is going up. Okay, so let's just look at the history here. So we can see that 30 years starting at 8%. Imagine you bought a 30-year bond at 8% yield in the 90s. That's a hell of a return. But if that yield went down for 30 years, you made even more money from the bond appreciating. And so because the government has really taken control of the central bank, or perhaps it's the central banks taking control of the government, there's one thing that's worked like clockwork, and that's the government is money hungry, power hungry, and slowly but surely they grow their debt at an accelerating pace. And so you'll see that over time, this yield just continues to drop lower and lower. So let's just scroll through it, pay attention to this. You'll see it bounces up and down. Anytime it bounces up means you have a healthy stock market. And again, if you had a truly healthy stock market, like you would be led to believe with this recent rally, then the TLT absolutely would not have been going up over the same period that stocks are going up. And you're going to see throughout history, anytime you have a truly healthy stock market, people ditch bonds and they buy stocks. But that's just not happening now. Okay, so let's look at the 30-year history here. So we're at 8%. This mark, I'm going to do my best not to make this blurry. I'll try to stop every 5 years. How about we go 5 years into the future, we're down to 6%. We go another 5 years into the future. Still at 5%. Okay, remember now, this is coming up to that dot-com bubble. So stocks are just hogging all the fun. So we got a little bounce, not a lot. Okay, let's go another 5 years into the future. And they've been switching on and off the 30 and 20 year, which is kind of funny. Okay, so here we are now, 2006, we're down to a 4% yield. So your bond value has gone up. Now you're still getting that higher interest rate, but your bond value has gone up. Let's go another 5 years into the future. Coming up upon the 2008 crisis. Let's look at our yield. So now we're in the low fours. Now we've dropped into the threes, coming at the end of 2008. Now we're at 3. Oh, got a 2.5 print coming into December of 2008. Okay, now we're having a little rebound as the stock market's flying up in this period, 2009. Yields are bouncing back up to 3.6. Hits as high as 4.5. Let's zoom into the future. 2015, we're back down to 2.5. What's going on in 2015? Well, China almost went bankrupt and they had to do a massive spending program to get that back on track. And let's just come to current. Where are we at today? What have we seen? Well, now we're at this was where Mr. Mark took a big profit on 306, and I think he got a little bit out on 309. So that yield went super low to 0.99. So that's the lowest we've ever seen in history. Today, we stand at 1.27. So bond market's telling you that. So what is it? So 30-year Treasury has about $800 billion of US debt that is constantly being sold and bought primarily by central banks, not on the TLT, not in the stock market. Okay, so we just have a proxy to that. The size of each bond, I believe, is $1 million. So it's just not feasible for us to play that market. But with the TLT, you can get in for $170 a share, but that share is just a little piece of a real bond. Okay, so that's what we're doing is we're betting that if interest rates are cut to zero, so let's look. Interest rates are cut to zero. Then we're expecting that primary dealers, central banks, are going to borrow from the Fed for free or just barely above free. And then they're going to have to make a purchase, whether they like it or not. Okay, so JP Morgan, that's their job. They have to buy any debt that's not purchased by foreigners. Okay, so they have to pick up this debt. They're borrowing from the Fed for free. They're buying a bond that pays a yield, so they're making money off the bat. But really, they hope that these bonds go up in value and that yields go lower. So as they sit there and buy and hold these, and they have free money from the Fed to do this, then it expands the bank's balance sheet, not the Fed's balance sheet. And they just continue to pile in on these as long as they think that there's economic downturn ahead. And so if we go back to this picture, SPY versus TLT, you can see like clockwork, red and green is SPY. SPY is going down, TLT goes up. SPY goes down, TLT goes up. What's neat about the TLT is that it doesn't tend to really get too much damage even when stocks go up. You can see stocks going up. But because our growth of debt was still expanding, TLT really didn't budge. Stocks went down, TLT went up. Stocks go down, TLT goes up. Stocks go crashing in 2008. What did the TLT go up? Okay, so that's the relationship. And let's talk about what's the problem solution, and then we can go to the next question and make sure that you have your questions answered. So banks love to find troubled businesses. They loan them money with typically something like a convertible note. Company can fix their problem, but then they end up not having money to pay off the debt. So they convert that into stock. If the company doesn't succeed, well, that debt note gives them the rights to liquidate their assets and get their money back. So it's a pretty sweet deal for banks. They love troubled companies. So normally a bank will find a troubled company, loan it money. If it works out, great. If it doesn't, they have first dibs at liquidating that company's assets. But when you get a problem that's so massive that a single bank can't swallow it, they team up with the government to achieve essentially the same thing. Okay, so we can see every single time the same pattern happens. The Fed drops rates, incentivizes purchasing debt from the government. The government comes in, bails out the important industries that are in trouble, keeps the jobs intact, protects the financial system. Once the losses have been absorbed by the general economy, which is typically done again by diluting the dollar. So anybody who's saved any money is losing. The companies who made bad investments are getting bailed out. And at the end of the day, it comes at the cost of the taxpayer. So they just do this like clockwork every single time. And they're doing it again. So the government has to bail out the economy. The banks are going to lend them the money, which they don't have. So they borrow that from the Fed. After the problem's resolved, the Fed will vacuum that debt off the bank's balance sheet with what they call quantitative easing, which shows up on this chart. And then the banks have made a big profit from loaning the government money, which it didn't even have. And they turn around and buy stocks super cheap, and your full recovery begins. So it's just really the playbook that they've used over and over again. So what's different this time? Well, the crisis is much bigger than $300 billion in mortgage securities that have been packaged into derivative products, which was maybe 3 trillion.
And that was 2008, right?
Yeah, 2008. So Ray Dalio estimates the loss to the economy, which I believe I think it's about $120 trillion economy globally, maybe less. But Ray Dalio is estimating no less than a $20 trillion hit to the global economy. So the size of this crisis is just massive, 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 and it's going to last multiple years. And so essentially to get to 300 to short, we're going to see it tap 180 as we approach. Where did that go?
Only got $10 to go.
Yeah, so we're close to 180. If we get to 0.99, we'll hit the 180. If we get to 0.5, which I think is very feasible,
Really?
into next year, then we'll be looking at 240. And if we want to get above 340, we're going to have to go to negative territory, which leads me to the next chart. Is it possible to go to negative yielding debt? Well, Germany is one of the largest economies in the world, highly correlated to China's economy. Has been a great leading indicator of where 30-year bond yields are going. And they just dipped back into negative territory. Last year, they got quite negative. And so the lower Germany goes, the lower we could anticipate our yield going. So because it is a global problem, not just a localized problem in America, I do expect bond yields globally to slowly but surely dip into negative territory. So if we think it's going to take 1, 2, 3, 4, 5 years to pay off and absorb the losses, for businesses to figure out what works, what doesn't work, for the losers to be weeded out of the economy, and for the winners to come out and start employing people and really thrive, it's not going to be an instant process. So that it just makes our predictions pretty straightforward. Now, does that mean it's going to be a straight road up? No, but again, with careful risk management, understanding the big picture, I think we're going to do just all right. Does that kind of answer what the
Thank you very much for that explanation. That's phenomenal.
Yeah, great, Dan, and music to my ears to hearing that. Thank you so much.
Can you explain on SPY why it's not going, SPY put, why it doesn't goes down? Why is it am I positioned right? 60% since I bought it, I lost on SPY put.
Yeah, my SPY puts are down. Let's see what they're down.
They're break even.
So yeah, I have the same losses as everybody else on the puts.
Okay, so I'm normal then, huh? Because I invested quite a bit too. On that one, I lost almost like 20 G's.
Yeah, so just keep in mind we have 2 years for this to play out, and we do anticipate adding to this position next Friday. So,
What
yeah.
about the one that expired in June 19? I am so scared of that.
Yeah, I'm gonna double down next Friday, most likely, perhaps even go to 3 of each. So.
Okay, on June 19, you mean?
This set right here, these 4, I anticipate increasing substantially the more time that passes.
Okay.
And I'm also likely going to add a May expiration. So yeah.
Okay. All right, so it's normal then. Okay, no problem. Thank you.
Hello?
Yeah, but with that said, we're still doing quite well considering what's going on here. So you really shouldn't, if you are following the program, here's my returns.
Yeah,
Hello?
excellent job, Jason.
Hey, Julio.
How you
Go
doing?
ahead, Julio.
Yeah, no, I have a probably very easy question, but I wanted to find out what are the tax consequences if you sell the TLT and the GDX in a non-IRA account? Can you explain a little bit about that? Because you said you need to hold at least a year, right? Is that
If you hold for over a year, you have almost half the tax consequence relative to hold less than a year.
okay?
So that depends on your tax rate and your tax bracket, that is, as well as your state, and as well as any kind of write-offs. So with that said, if we use options, we can buy positions, hang on to them, reduce volatility, and only have short-term gains on the protective puts primarily, and the short-term call options.
Okay. Thank you.
You're very welcome. Good question. Karen.
My last question, I think it's quick, but if it's not, you can defer it. It was about the FXI comment you made earlier, when you showed the chart, which of course we all know every time they have a hiccup, the PBOC comes in and supplements them. And you said, but you believe that will taper off. And I know you've got the put on, so I'm just wondering kind of what you're thinking the time frame is that they might just taper off. I just kind of want to watch that, kind of throw up some indicators for myself so I can watch it. That's all. And if it's too long of an explanation, we can hold off on that one.
Oh, no worries. Trying to find that chart. Let's see.
Yeah, because you're running short of time.
It's okay. Oh yeah, we're coming up on the boot camp in 20 minutes, huh?
Yep.
The heck happened to my emerging markets tab? There we go. So yeah, these are the Chinese stock markets, extremely small compared to the US market. It is outperforming, but again, I'm expecting sanctions against China either this year or next year. But it is highly, highly correlated to the general stock market. So I anticipate we'll be selling that put around August.
Oh, okay. So okay. So kind of just exactly what you're saying, coinciding with when you're thinking we're going to decline too. Okay, that makes sense. All right. That's just something I wanted to have in my mind and have some clarity. So I appreciate that. And by the way, yeah,
I do want to throw this out. If they rush opening the economy and just let this rip through society, I don't know if we'll be buying anything in August. So we have a lot of time premium on our options, and I'm happy to hold it until I do think we have at least some sort of strong footing to get into.
Right. Makes sense. Thanks.
You're very welcome. Let's see. I think there's another hand somewhere in there. We got 86 live. Thank you guys all for joining in. Ron, haven't heard Ron's voice in quite some time, but he definitely gets the highest attendance award. How's it going, Ron?
It's great. I enjoy it. I just had the Qs, they overtook their 50-day. I just want to know your opinion about the Qs.
I love to short the Qs right here.
Okay.
Absolutely. Yeah. So that's one of our boot camp trades that we're up quite substantially on. So I'll probably green light that for boot campers as a good trade again, although it's deep in the money. So we might have to readjust that.
Yeah, I was going to say, I figured you were going to attack that one again.
Yeah, that's absolutely absurd.
Okay, great. Thanks, Jason. I appreciate it.
And if you do the FANG version of this, it's actually up for the year.
Oh, really?
Which is just absurd. Mostly because of Amazon.
Yeah, Amazon and Netflix and stay-at-home stuff.
Yeah, but Netflix is going to run out of new shows. Amazon's customer base is going to run out of money.
Yeah, it has.
Amazon's over
Facebook's
2,400 today.
Facebook's revenue is going to get crushed, and Google's revenue is going to get crushed. So,
Yeah, I think we're the only ones increasing our Google ad spend, Jay.
yeah.
You guys need to get a
Exactly.
discount then.
I
Negotiate
know.
a deal.
I was thinking about that, Karen. We need to reach out to them.
Oh, you better believe it. They must be hungry. So, you know.
Right?
And your
Yeah.
YouTube spend. I hear my voice on there all the time.
Awesome, Mark. We're going to make you famous.
Oh, and Mark, I finally got you and Roy your gift cards. So thanks again for those referrals. Did it arrive?
Not yet, but I haven't checked the mail in a couple days.
Oh, it should be in your email.
Oh, email. Oh, okay.
Yeah, digital Amazon
Yeah.
card. There you go.
There-
Some more money for Amazon.
Right. Hey, and Jason, just want to let you know, bud, 15-minute warning to the boot camp. And just want to let everyone know too, if you're on a trial and you haven't signed up yet, if you do sign up, you will get access to the boot camp webinar on the pro level. Okay? So if that's something you're interested in, hit that options button that's in the chat, or I'm sorry, you have to copy and paste it now, and then just pick out from the pro, whichever one you want to do, and we'll be happy to get you access to that boot camp presentation. And Mark, thanks again. Appreciate it. I talked to another one of your referrals earlier this week.
Oh
Sure.
man, poor Roy. I had him pull the Band-Aid a little early, huh, Roy? Roy out there. Let's see if Roy wants to say something before we probably close this out and go to the webinar.
We heard from Pat yet today.
For the, thank you for the gift card.
Oh, you're welcome, Roy.
Hey, thank you, Roy. Appreciate the referral.
No problem.
You know, I just don't know anybody that has any money. anymore.
What's
That's the
going on
problem.
in the corporate world, Roy?
You're right about ad spend. Ad spend's down about 50%.
Wow.
That is right on the money.
So Roy, everybody's highly connected up in the big leagues in the corporate world. So we got so many very intelligent people in our group. It's really a pleasure. Anything else you want to share with the group, Roy?
Not at this time.
Okay.
In China, they used to call Roy Pang Loban,
What's that?
fat boss man.
Unfortunately true.
Getting that Peking duck.
Let's see, Tyler G and Marlene.
Me first, or?
Go for it.
Oh, I just wanted to ask, well, I don't see the link yet for the 11 o'clock, but I got an email alert today that there were 3 portfolio optimizations that were sent, but I didn't receive an email.
Oh no. Okay, so here was the email. The title of the email was Short Stocks, Buy Bonds, and Buy the Next Gold Dip. The trade was, now I don't think you're following the TLT positions, right, Marlene?
Right. So that didn't apply to me then.
Yeah, no change.
Okay.
Yep.
Okay.
You got it.
No problem.
And great
Okay,
question.
So I'm going
And
to be looking for the Fed to taper down its bond purchases, which it really needs to do. If it expects $1 trillion to $2 trillion to be added to that 30-year Treasury, which is what they say they're going to do, they have to force everyone to buy and hold these. And so they do that by reducing the QE. So I think they just want to stabilize everything. The Fed just basically bought all the debt that they've issued recently was in the front end of the curve. So the T-bills, the Treasury's got like almost $1 trillion in the coffer right now. And now they need to roll that debt from short-term debt into long-term debt. So I do believe they'll do that with, yeah, the government's quite clever. They like to go stir up the rest of the world, create geopolitical tension, crash other people's markets, and then force money into to the good old USA. So that's probably coming on top of a reduction in quantitative easing, which again will be very bad for stocks and very good for bonds. Tyler G, please.
I think he asked in the chat, where do we log the Forex trade in the spreadsheet?
Oh, good question. So I'll cover that in our bootcamp spreadsheet tutorial coming up next. But I just have it in the stock position. So I'll show you how I've entered that. So I've essentially just said I sold it for 12, and now we got to see what we end up buying it for in the future. 12 cents, 12.8 or something. Good question, Tyler. Okay, great. Any, Dan, go ahead.
We're getting that little pullback in gold.
Oh boy. Well, yeah, so, you know, funny enough, this has actually been a hell of a leading indicator. So I wouldn't think we have a big crash coming just this moment with crypto doing so hot this morning. Now, is there a chance that the inflationary assets ignore deflation, just focus on all the money printing and lose their correlation to the stock market? It's possible, but not probable. So that's why we're still playing it the way we currently are. So we can look at that.
2% off the daily high.
Yeah. So yeah, I mean, all the big central banks really control the gold supply, so it's quite easy for them to dump it right when they dump stocks and put that big push into the bonds. All right, guys. Well, I'm going to take a little break before our boot camp webinar coming up next. Our goal is to review the Hong Kong trade. I'll show you how to input in your spreadsheet, and then we're going to work through our new spreadsheet and learn how to fill it out, which is should be in your drive. And I'll teach you guys how to find your spreadsheet as well.
Awesome, Jason. And for every trial, I did post the options link. Just copy and paste that into your browser. And then once you do the upgrade, we'll actually get you an access link into this afternoon's webinar. So I look forward to seeing you all in there. And thank you all. I think we had 5 or 6 people book some calls during the meeting. So I appreciate that. It really made my time more efficient. If you haven't done that yet, please do it, guys. My calendar is literally going to be completely full next week. So get that spot booked while you can, okay?
Thank you very much, Dean. Thank you very much, Ryan. Thank you, guys. And we'll see you in a few minutes.